Welcome to Trading Strategies for February. I'm Scott Gamm. Here's what's coming up over the next hour. Is volatility back? The stock market moving all over the place this week. We have a plan of action for you. Changing of the guard. Jerome Powell to succeed Janet Yellen as Federal Reserve Chair. What does this mean for investors? And tech earnings. It's the busiest day of the quarter. We are just hours away from Apple, Alphabet, and Amazon earnings. We've got you covered, and you can send us your questions. We'll be answering them with our panel throughout the hour. Let's introduce everybody. Ann Sonders is the Chief Investment Strategist at Charles Schwab. Jeff Marks is Senior Portfolio Analyst for Jim Cramer's Charitable Trust Action Alerts Plus. Kristina Hooper is the Chief Global Market Strategist at Invesco. And Tony Dwyer is Chief Market Strategist at Canaccord Genuity. Welcome, everybody. I want to get your reaction to the crazy week we've had in the markets so far this week. We had a 400-plus point drop in the Dow on Tuesday. Yesterday, we had a reversal in stocks. Now we're up. Ann, start us off.
Well, first of all, the drop was 1%. So I think it's a little bit of a reality check for people who actually think that that's an extreme move. But the reversal days, interestingly, started before this past week. You've had a couple of key ones. And even recently, when the market was still at all-time highs, you had seen about a 40% pickup in the volatility index. So the flavor, the characteristic of the market started to look a bit different as we headed into the beginning of the year. And it's been our view that 2018 would not look like 2017, that we're probably still in a secular bull market, and there's decent runway ahead of us, but it's probably a runway with quite a few more potholes than
there's this debate over whether the easy money period in the market, so to speak, is over.
Well, you've got record easy financial conditions. They may get a little bit easier from here, but more likely they're going to tighten from here. QE to QT, probably at least 3 rate hikes this year, and it's a realistic assessment in light of the pickup in inflation expectations. And that's there's a lot of investors and traders on Wall Street that have never been in an environment that is not disinflationary or deflationary. So I think that change in character is not something that a lot of investors are used to.
And we're going to talk about the Fed throughout the hour. But Jeff, your thoughts on some of the volatility this week?
Yeah, I think this week a lot of it had to do with the Fed meeting that we had the other day, end of the month. There was some rebalancing going on, and the extreme gains that we had so far this month, I think was the 11th best month that we've had, start to the year that we've had since 1950. I think a lot of positions got a little bit too hot on some people's books, and they had to trim some of those bigger names down to stay a little bit more disciplined as we head through the next 11 months of the year.
Kristina?
Well, I would say that we've seen this market really change, and I would say 2017 was an environment where it was almost euphoric, that we didn't have any major pullbacks. Market rotations became the new market pullbacks. And now as we enter 2018, I would concur with Ann that this is an environment where the bull market is maturing. The easy money, to a certain extent, has been made, but that's a good thing in that active managers are better able to differentiate themselves in this kind of environment because correlations are going down, fundamentals matter more. It just makes sense given where the Fed is, and it appears to be pulling away accommodation.
You mentioned euphoric. I haven't really heard that term in 2017, but I've been starting to hear it the first 3 weeks of this year, and we know what John Templeton says, bull markets die on euphoria.
I would say that if we were to look in the rearview mirror, 2017 seemed quite euphoric. We didn't have any stumbles, really, for the stock market. It was a very forgiving environment. And 2018, I think, is certainly different. To me, it suggests the next leg in a journey that is coming closer to an end.
Tony?
Well, certainly, Scott, I think, and thank you for having me, I think you see the light at the end of the tunnel, and it's a train. When the Fed starts to raise rates, you're going to end up inverting the curve. Janet Yellen did the unthinkable. Same thing that Alan Greenspan and Ben Bernanke did. She suggested that you can invert the curve and it'll be okay. The only thing that ends a bull market, full stop, even I got into the business in 1987 when rates were going up and there was real euphoria with a 40% gain in the S&P in the first 8 months of the year. That's euphoria. So The problem is when they invert, that wasn't the peak of the market. That was 1989 after the curve inverted and the Fed shut down credit. So you need a credit shutdown to go into a recession, in a levered economy especially. We're nowhere near that. So that freight train is still a long way down the track. However, the Fed tracks something called the Monetary Policy Uncertainty Index. And it scans all the newspapers and all the major periodicals for monetary policy fear-based kind of comments. That has been a historic low, to Liz Ann's point, over the course of the last 18 months. And it's easy to say it's not euphoria, but it's been crazy. Early 2016 didn't feel so euphoric in this cycle. So we've had a good run off of a real inappropriate drop.
Liz Ann, do you agree?
Yeah, I do. And I also think that if you look at attitudinal measures of sentiment, almost all of them are at or near record high levels of optimism. In the case of, say, AAII's come down a bit in light of the volatility that we've been talking about. The potential good news that may sort of extend the period a little bit is that the behavioral measures don't match that same kind of enthusiasm. We have seen a pickup in fund flows, but that's largely been outside the U.S. If you look even inclusive of equity ETFs and you focus solely on the U.S. equity market, on a cumulative basis, not a single dollar of net new money has come into the U.S. equity market, even including ETFs, since before the financial crisis. So if the behavioral side matched the enthusiasm of the attitudinal side, to use Tony's analogy, I'd say that the train was probably a bit closer, but I think that gives us maybe a little bit more wiggle room.
So cash on the sidelines is what you're saying.
Well,
right?
Depending on how you measure it, cash levels are fairly low, but that to some degree is also because interest rates have been so low. So a lot of the money that may have historically been in what we generally think of as cash instruments may have just gone out the duration spectrum a little bit into fairly liquid fixed income instruments. So it doesn't get picked up as cash, but it is money that could move.
There's an interesting, to follow along the same line of thinking. When the last time you had investors' intelligence bears at 12% was 1986. There was a 40% run up in stocks from the end of 1985 into that March of 86 peak. So it happens more than once. So our playbook for this year, 2018, is similar to 1986, where you have 12% bears in investors' intelligence, which measures newsletter writers. Then there was 4 corrections of 5% or more over the next 6 months, and what proved to be a very good year. So I think I'm high on the street or close to it for my S&P target, but to the lady's point, it's going to become a lot more volatile, and rather than chase the next tick, it's a year, to Kristina's point, where you can absolutely buy weakness when nobody's going to want to. Remember, corrections are only natural, normal, and healthy until you actually get one.
Yeah, well, and your target on the S&P 500 is 3,100?
Correct.
Is that conservative in your view?
I could be 100 points too low. The earnings numbers are ridiculous. Like, for example, this quarter, the fourth quarter of 2017, early expectations were for 9% growth. It's currently 15%. So if you even take out energy, you're still at 12.9 according to Thomson Reuters. That's before the tax cuts.
Right. Well, and we're going to talk about earnings a little later on, but this week the 10-year yield was in focus. We are now at 2.769. Everyone kind of freaked out when we even breached 2.7 and even lower than that. How much of the sell-off this week was attributed to a rising yield, and at what level in the yield do you think that would start to disrupt the case for owning equities?
I think there were a lot of contributing factors to the pickup in volatility. I think it's very natural, certainly by the financial media, to have one thing to point to with any kind of move in the market. And that is, to some degree, kind of silly, as if the market is this inanimate object and waits until the single piece of news comes out that day and then moves one direction or another. But I do think if we want to sort of talk about the non-sentiment related triggers, I think not just the U.S. 10-year yield going through 2.7, but you saw a big move up in yields globally as well. So you saw it in Germany, you saw it in Switzerland. So you're starting to chip away at some of the negative yields that we had. And I think just this tighter monetary policy is no longer purely a U.S. story, it's a global story as well.
So is the bond market trying to tell us something, Kristina?
Well, I think there are a lot of different interpretations of what the bond market may be telling us, right? Some say it's a proxy for inflation. Some say it's a proxy. The 10-year is more of a proxy for global growth. The short end is more of a proxy for U.S. growth. What it's telling me clearly is that inflation seems like it's going to pick up a little bit more. We're seeing that from market-based expectations as well, if you look at, for example, tips. But at the end of the day, all it means is that borrowing costs are going higher. And interestingly, there was a firm back in November that put out a research note that suggested that if the 10-year hit 2.75%, that there would be a re-rating of equities on the order of 15%.
Huh.
And so I think that that has gotten in the heads of some investors, at least, that this is kind of that point where you have to start worrying. So I think there's some psychological impact to hitting that 2.75 mark this year that has put downward pressure on stocks.
And we just hit 3% in the 30-year Treasury yield. So we're finally seeing somewhat upward pressure on inflation expectations, Tony.
Well, finally, you should have. You had global synchronized growth for the last 18 months. You've had an acceleration in U.S. cap spending for the last 12 months. The consumer's ripping it, and that was before you got the tax cuts. So you actually have the. So here's to follow along the fundamental reason why you may be going into this period of more corrective action followed by ramps. You've got a discrepancy between what the Fed sees and what investors are looking for. The Fed sees strong economic activity. They don't go relative to expectations. They see strong and global activity, strengthening U.S. activity. The inflation break-evens are up to past 2% now. They're getting nervous, so they're getting more hawkish. At the same time, the Citigroup Economic Surprise Index reached a very rare level and is inflected lower. So now what you've got is a Fed that's seeing strong growth lifting short rates and a long end that doesn't know what to do with it because you're disappointing on the actual data that's coming out, even though it's strong. And therein lies this tug of war of why you're getting these 3-day whooshes, technical term, followed by 3-day ramps.
The other important inflection, too, as it relates to inflation, is that we closed the output gap finally. So now we have an economy operating above potential. And then more recently, we also saw nominal growth move above the unemployment rate. And Jim Paulson at Leuthold put out an interesting scattergram recently that looked at eras where nominal growth is below the unemployment rate, and there's not a high correlation between changes in the unemployment rate and wages. So it's where sort of the Phillips curve breaks down. But you get to that point where growth is above the unemployment rate, and that slope really picks up, and you sort of kick the Phillips curve back in. So that's something that I don't think has generated a lot of attention. I think the combination of those two really does change the outlook for inflation.
Yeah, because the Phillips curve has been under attack for a long
Well, it hasn't
time.
worked, but there's actually an economic reason for that.
Yeah, I mean, I think it's just been a very weak, low-quality jobs recovery. And you can see it in terms of the kinds of jobs that have been created in the recovery. It's been largely retail. We've lost manufacturing jobs. And interesting, we may be just on the cusp of a reversal of that. In last month's jobs report, what we saw was a loss in retail jobs and a creation of manufacturing jobs. And that could portend a trend that could significantly boost wage growth.
And when you look at the Philadelphia Fed did a great research report that very few people have actually seen. And I key off it because people have referred to the savings rate being low and how that spells bad things for the consumer. It's the most revised data series in economics. It is absolutely useless on a current time frame. What they found is that the nominal disposable personal income is underestimated by 8.4% per year since 1965. So think about that. We're in a hot recovery right now, especially given the tax cuts, and you know the data is underestimated. Therein lies the reason that the Fed will invert the curve. So I would make the case that the long end going up all the way close to 3% is actually a good thing. It gives the Fed more time before they invert the curve, because ultimately that's what shuts down credit. It's not absolute level of rate, it's spread. What makes a bank lend? When they get money cheaper than they lend it out at.
But still, the economic data, as you all have been saying, is pretty hot out there. So, Liz Ann, you mentioned 3 to 4 rate hikes this year. Some are even calling for more than that.
Well, we have a transition from Yellen to Powell. Ostensibly he has the same approach, relative gradualism, but you did just see the likelihood of 4 rate hikes based on the futures market jump to over 25%. We're basically at 100% for March, but it's way overused by the Fed and everybody else. It's data dependent. Yeah. So a lot can happen. I think that can change that trajectory. But I think 3 is easily on the table.
Jeff, at Action Alerts Plus, obviously you guys have Citigroup, J.P. Morgan. When we're watching yields, those two stocks are going to be affected most.
Yeah, and what we're factoring in is the 3 to 4 rate hikes as well. We thought even there was an outside possibility that maybe there could have been a surprise one given what the markets have done over the past month at the meeting yesterday.
A little drop the mic for Janet Yellen.
Well,
right?
yeah, maybe that's probably not how she would wanted to go out, but I think it's more, it relates to the global synchronized growth and what we've seen in the past month. But back to the point, 3 to 4 rate hikes, they go great with the financials, as the net interest margins on these banks will improve. Now, last quarter when these stocks reported, they were a little bit softer than what people would have hoped for, but we think those rates will normalize over time. And with expected deregulation coming from the Trump administration, we think that it's a great setup for financials this year.
Mm-hmm. Kristina?
Well, I would just say that I think we shouldn't overestimate what the Fed's going to be like. In other words, we shouldn't expect it to be very similar to the Yellen Fed. I think there's a good chance we could see a more hawkish Fed with the potential for a hastening of balance sheet normalization. And to me, that is actually the far more powerful tool of the two tools that the Fed is currently using. We've got Marvin Goodfriend coming on. He has been historically a real critic of QE. We have a Fed chair who is not an economist for the first time in decades.
Yeah, he's has a markets background.
And he could focus on, for example, deregulation and perhaps take a back seat to some of the economists on the FOMC. So I just wouldn't assume that the December dot plot holds for what is a decidedly different FOMC. And therein lies what could be the big risk to markets in 2018. Now, my expectation is an upward bias to stocks because we've got this great global growth environment and we have very accommodative monetary policy. But one risk to that scenario is, of course, a Fed that is more aggressive than we expected.
And that's the data. We love to personalize these folks. Like they're doing it. It's not like Janet Yellen was, wow, inflation's really high, I don't care, I'm going to be dovish. Inflation was historically low. Inflation break-evens were historically low. Remember when Ben Bernanke came in, it was helicopter Ben to the rescue. The Fed had raised rates a double-digit every meeting in a row for something like 10 meetings. Ultimately, it was 17. So he comes into office, and everybody's calling him Helicopter Ben. I renamed him Submarine Ben in the first week of 2008 because the man wasn't easing fast enough based on what the credit markets and the data was telling him. So we have to be careful to make sure that we don't personalize what the Fed does. They go by inflation expectations.
Well, Janet Yellen...
but they could be spooked by inflation expectations. I think the data is starting to change.
And therein lies the volatility from that monetary policy uncertainty index. You look for a pickup in that.
Also, April, right? I mean, that's going to be the first time since the financial crisis that the Fed balance sheet actually starts to shrink. And I think that speaks to your point as a wild card for the markets this year.
Absolutely. It was a very powerful tool as the balance sheet was growing, and it could be a very powerful tool now. Now, I understand that Janet Yellen has done everything in her power to try to make this as gradual and as...
Watching paint dry.
Exactly. But, and her assumption that it would operate in the background. But I think there is a reality that particularly if for some reason the Fed decides to speed up balance sheet normalization, that could be disruptive.
Well, it's also potentially a risk in both directions, meaning the Fed, if they do the right thing, they don't let inflation get away from them, and they maybe tighten policy a bit faster and sharper than some people are expecting. But this idea that it would be a good thing if they held back and maintained a dovish position while inflation took off, that's not a market positive. So an easy Fed in an environment where the data is telling them, hey, you're getting behind the curve is also not a great story.
Because then they have no dry powder to help if things go south.
Well, the dry powder is really, it's not even the Fed. It's been the pension plans and it's been the commercial banks. So Scott, if I told you and all the other people here that at the end of 2013, from the end of 2013 to the end of 2015, that our two biggest treasury holders, which have never ever, not only not sold, they've never not bought treasuries, that they were going to sell $250 billion. Would you imagine that there would be a 2 handle on the 10-year note yield? Not a chance. They sold $250 billion worth of treasuries. Commercial banks bought $400 billion worth of treasuries. So we have to be careful to make sure we know who's buying, offsetting the so far minimal Fed selling.
So with
Rolling
that,
off, they're not selling.
would that then make it even more important to have someone like Powell running the show with his markets background to navigate those waters?
If he's going to be a dictator, I guess, but they don't work that way. I mean, they work on a team. The team will talk. They will show an enormous amount of data, ridiculous amount of data, and they'll come to a conclusion where he will go to the podium. But when Ben Bernanke came into play, he decentralized the decision-making at the Fed, in my opinion.
Who do we think will be better for the markets, Janet Yellen or Jerome Powell? Because the S&P 500 is up almost 60% during Janet Yellen's 4 years.
The policy, the monetary conditions and inflation were better for the market, which happened to be under the reign of Janet Yellen. I agree with Tony. I think it's not so much dangerous. I just think it's inappropriate to put the credit solely on the human being at the helm of the Fed in a bull market that was driven by fundamentals that had a lot to do with liquidity being generated not just by the Fed but global central banks, and maybe what Powell is going to bring in. You got to always sort of feel bad for these new Fed chairs because they do tend to have some disruptions.
I mean, before you used to have 2.5 months before you had the Fed minutes released. Now it's 2.5 weeks, and you have a press conference. You never got to ask questions before. You did what you wanted to do and figured it out later when the new data came out.
And the bull market was younger during Janet Yellen's tenure, which I think would be a good thing to discuss right now in terms of what you think the age of the bull market is. Is it 9 years like most people have been saying? Is it younger? Should it have started in 2013? That's a year I've been hearing.
Anytime I've referenced, particularly if I do it on social media, on Twitter, the 9-year bull market, you get these nasty responses back that provide all the data on corrections throughout the period of time that either were corrections in time more than price, and they didn't. I get all that, but yeah, for using the simplistic definition of 20%, it started in 2009. If you use a more nuanced definition that might take time into consideration and allow for less of a decline, then you've had plenty of big hiccups, and that you could maybe say we really started kind of post-taper tantrum.
You know, we've talked about some of the negativity this week, but we should still acknowledge, and you had pointed this out, that the market is up 6% so far this year. That's, in some years we've had that in an entire year rather than the first month of the year. So we should acknowledge that. But do the newly passed tax cuts, does that reset the clock of the bull market in your view?
Well, the market correlates to the direction of earnings, full stop. So you need to figure out what does that. And our core thesis is the market correlates to the direction of earnings. That's driven by economic activity. That's driven by the slope of the yield curve and availability of money. That's driven by Fed policy. That's driven by core inflation. So with all those things still being less positive, but still positive, so let's say our call is for $155 in earnings this year for the S&P 500, which is double-digit gains. We're currently up 6%. So throughout the rest of the year, you would have to argue that you're going to get a multiple contraction to not match those earnings returns.
And if inflation picks up beyond expectations, that can be maybe not a multiple killer, but a
suppressor. Yeah. So up 6%, are you going to go up another 20? Probably not. But could you follow the trajectory of earnings? Likely.
Is that, you said double-digit earnings expectations growth for this year. FactSet has it at 16.3%. Is that a high hurdle to meet?
I think it's too low. My 155 is probably too low by a good $5.
The one thing I'll say though, be careful what you wish for. If you look at GAAP earnings, you go back to long history. I think this is post-World War II data. And you break earnings into a few zones. Now, the worst performance for the stock market has come when earnings are literally imploding, like down worse than 25%. However, the second worst performance for the stock market, where it generates only about 2% annualized returns, is when earnings are in their highest zone, more than 20%. So we know the market's a discounting mechanism. The thing I think investors miss most of the time as it relates to tying market action to economic action or market action to earnings is that inflection points really matter. And the market has a tendency to sniff out inflection points. The problem with a lot of individual investors is they wait until the data is great, whether it's the economic data, whether it's the earnings data. You've probably missed most of the move on the upside. And I just think that at some point we may get to the point where the expectations bar for earnings gets set a little bit too high.
But this is a sort of an unusual year to be talking about earnings expectations when we have this sort of once in a lifetime tax cut. Jeff, in the trust, there are a host of different companies that will benefit from the corporate rate going to 21%.
Yeah, absolutely. I mean, you take a look at like a Waste Management who's going to greatly decrease their tax rate, or a Nucor and Infrastructure, they're going to greatly decrease their tax rate. And Waste Management, they're offering bonuses to $1,000 bonus to a number of employees too, which could also have an effect into some other sectors in the industry. But when I look at what the market's done this year, and we see that the S&P is up 6%, as you said, and some stocks that that you most likely had in your portfolio, they're probably up greater than that. But I think it all some of it feels a little bit too greedy at points, where I think there you want to scale back and lock in some of your year-to-date profits this year and build up that cash balance and keep up your optionality and flexibility to take advantage of potential pullbacks that come later in the year. But overall, I mean, yeah, these tax cuts are going to do a great benefit to earnings per share for a number of companies.
Yeah, guys, how are you following the tax cuts? I mean, what inning are we in for those benefits this year?
Well, we're early in, but what I would say is that so many companies will have a very different impact from taxes. Each company has its own unique tax profile. Some have effective tax rates before the tax reform legislation of close to 40%. Some had close to 20%. So the effects will be so different on different companies, and it generally you can aggregate it by sector. But I think it's a mistake to just look at earnings growth in general for the S&P 500. We've got to dive down into sectors and companies and recognize what an impact it will have. And again, I think this goes to the argument about active management. This will be a year where active management matters because tax profiles are unique based on companies, and some will do better than others.
Tony, what have you been telling clients about tax reform?
The driver of the tax, so from a sentiment standpoint, I think it's fully discounted. From an actual standpoint, we're just in the first batter of the first inning. We have no idea, to Kristina's point, of how positive it's going to be. It's going to be positive. We don't know how much. We have a good idea based on prior year tax rate and likely tax rate. But to drill it down to the sector level, the sectors that mean the most to earnings are the ones that benefit the most. You've got industrials, you've got financials, especially some of the names that Jeff talked about have major positive influence coming from the tax legislation, and therein lies the opportunity. So I think, and where we've called for a pullback in this volatile period coming up that you want to take advantage of, there's too much positive sentiment. When you can, a year ago, you had the Citigroup Economic Surprise Index at -80. Right? Now it got up to +80, and it inflected into Lizanne's point. None of this stuff matters until it's at a historic extreme and inflects. Like the Citigroup Economic Surprise Index doesn't really correlate to anything over time ever, unless you're at a historic extreme and it inflects because it shows you too much optimism.
Yeah. Let's dig deeper into some of these sectors. Obviously, we have a ton of tech names reporting today. Jeff, we had Microsoft and Facebook last night. Update us on your thesis on those two names for the trust.
Yeah, both had excellent quarters. I take a first look at Facebook. I mean, it's very funny when there's always some type of theatric that comes out when Facebook reports, and it happened right away on their earnings release when Mark Zuckerberg dropped almost like a bombshell and said that 50 million hours per day due to some of the changes that they've made to the platform.
That they lost 50 million hours
correct,
per day.
Correct,
yeah.
And immediately sent the stock lower. But then as you learned on through the commentary, through the conference call about why they're making these changes, what it's doing to the meaningful social interactions, and Sheryl Sandberg came out and said, as it turns out, as a result of some of these changes, they actually think that it's going to lead to more monetization opportunities because the advertisements are going to be more targeted and they can charge more. So I think absolutely great quarter. I mean, excellent earnings power there.
And investors seem to agree the stock up 3.3% right now. You guys trimmed some earlier this week.
Yeah, and that just goes back to being balanced. It was our largest position, overweighted. We didn't want to have too much single stock risk heading into the quarter, especially one that typically sells off into the quarter. But again, it was too big because it's been such a winner, and we think it's still going to be a winner, and that's the bottom line there.
Let's talk about single stock risk, because Lizanne, I think people don't realize that even if you have money in a broad S&P 500 ETF, stocks like Apple have a huge weighting, and so when we see Apple down, which it's been so volatile, that impacts the broader market.
No question, and I do think, I agree with Kristina. I think that this is a very interesting year because it's probably the first year in quite some time where the playing field has been leveled for the benefit of active. That's not to say passive gets thrown out the window, but the crash and correlations in particular really set up active to be in a much better position. And a rising share of active managers are outperforming their benchmarks. And I also think it's going to be either extended or exacerbated by, to Tony's point, tax reform piece. What was interesting is back in the late August to beginning of October time period, there was this knee-jerk reaction on the part of investors when they realized that tax reform looked like it was happening to make generalizations about the winners and the losers. And you saw this massive small cap surge in the month of September when people just made the assumption they're bigger beneficiaries. Well, then, I think rightly so, investors started to actually do the work and said, well, wait a minute, with the change to interest deductibility, the smaller companies are more indebted companies. The offset is significant, and they're not the biggest winners. But then that's even a generalization. So I think the work is finally being done, and there's a lot more to be done to look at individual companies, industries, and sectors.
Tony, do you agree?
We've tried to make this cycle different somehow, and it's been elongated. But ultimately, when you look at small caps or mid caps relative to large caps, they peaked in relative performance when the Fed started raising rates, because that's how it works. And that is offsetting the positive sentiment that comes from the tax cuts. And certainly where active management is going to win, we're all kind of biased here, but where active management's really going to win is because a passive vehicle can't disseminate or differentiate an earnings miss that got inappropriately taken apart on. Right? They don't buy the weakness in that single stock, whereas if you have an active manager, which is our client base, that's where you can actually make a lot of money. So I would argue that normally the first half of an economic cycle, when monetary conditions are easing, there's zero Fed stress, and everything's kind of rosy, yeah, passive should win. Everything goes up. You don't have to differentiate. It's now when the Fed starts to raise rates, corporate debt yields are beginning to go up. It becomes more expensive to just throw money out into the debt market. You need an active manager to figure out which managements are going to do better with that.
And do you need to keep your money in these high-flying sectors like tech, the ones that have run up so much?
Well, my opinion is so not relevant. Let's look at history. When the yield curve has narrowed from where it is, about 60 basis points. The 210 spread on the U.S. Treasury yield curve hit 60 basis points initially last November. When you look 6 and 12 months out from there, the most consistent outperforming sectors are financials, infotech, and industrials, which are our overweight sectors. I'm not trying to reinvent the wheel. I'm just going by what typically happens.
And I think there's a special reason to be excited about tech right now, and that has to do with the tax reform legislation. Recall, it's not just a tax cut. There are a lot of elements to it, and one of them incentivizes CapEx spending. And so what we've heard from a lot of the earnings calls thus far is that companies intend to spend more on CapEx. And from my perspective, I think that tech will be a very big beneficiary of a bigger CapEx spend.
And Jeff, the numbers show that. I mean, we were talking about Microsoft before we came on, 98% revenue growth in Azure in its most recent quarter.
Yeah, I mean, this quarter's results were completely driven by the intelligent cloud, and we think that this is a trend that is still underappreciated in the market, even as we see a lot of these cloud-related names go higher. Microsoft, they have one of the biggest cloud footprints. We think their cloud, Google, Amazon Web Services, still, even as these gains that we've seen with these stocks, we still think it's underappreciated. And I want to make an additional point back to the importance of some of this active management when you look at what's going on with tax reform. I take an example. We hold Comcast, right? This is going to be one of the best financial engineering stories that we're going to see because of of the tax cuts. Their free cash flows are phenomenal. They're going to be buying back a ton of stock and issuing dividends, and that's something that you just wouldn't understand if you didn't have a chance to look at some of these stocks that will benefit from tax support.
And their tax rate is 35%. They have one of the highest out
right,
there.
and that's going to come down, and you know, we may not see it immediately, but I think over time when they start buying back this stock, it's going to be great.
Just also back to tech, because we do have Apple, Amazon, and Alphabet in just about an hour and a half from now. So give us a sense of what to expect, especially Apple. A lot of worries about the iPhone 10.
Well, I mean, the 10, it may not sell great, but I think there's so many more things to look at from a longer term approach with Apple. I think for starters, the average sale price is going to go higher. I mean, they're incorporating the 8 and the 10, and that price is going to go up. And even if sales are a little bit low from a unit perspective, it's going to offset with the higher price. Second, the revenue, the service revenue stream. That has been an absolute powerhouse for the company. It's growing at a phenomenal rate, and as the iPhone ecosystem builds out, they're going to have more revenue there. And finally, when you look at Apple, I mean, it's a tech company, but it's more of a consumer product company with the best technology out there. And if you look relative to some other consumer product companies out there, it's still relatively cheap. So when I take a look at Apple, yes, the quarter might not be great, but they have the best technology out there. They have an iconic brand. And I just wouldn't want to bet against them for 4 years down the road than tomorrow. So I'll avoid the smaller miss for the bigger gain.
And of course, we'll watch what happens at around 4:30 when they report.
Absolutely.
But there's a lot of concern when it comes to Apple and China, right? iPhone 10 demand there. But guys, I mean, the China economy seems to be holding up pretty well. Growth was at 6.9% in 2017. You know, it's still held up from all those worries we saw about the China economy in 2016. So what do you guys make when you hear worries about Apple in China?
I can't comment on Apple specifically.
Sure.
I can comment on China.
China, yeah.
Right. The economy that was supposed to collapse when the $1 trillion stimulus package went away.
Sure.
You know, of course it didn't, because it takes time to feed that through. So the Chinese economy is doing well because 24% of the global economy is in the U.S. The U.S. is doing increasingly well. And I think, importantly, Europe has been terrific. When you look at the manufacturing and service sector in Europe, it's been great. The PMIs have been positive since the low in 2016 because they've been buying corporate debt at the ECB. So if you want to talk about cheap money, you know, when they had a negative interest rate policy of minus 10 basis points and there was speculation that they were going to go to minus 20 basis points, if you're not doing it at minus 10, you're probably not doing it at minus 20. So they came up with the idea that they would buy corporate debt. What a huge decision that was. So many companies, any company that had corporate debt denominated in euros, whether it's in the US or China or anywhere else, refied that debt, had a huge cash flow savings, and reinvested that either in share repurchase or cap spending, to Kristina's point. You get a lot of benefit from that. That's starting to reverse. So our call has been, up until this year, has been EM over DM, emerging markets over developed markets over US, as optimistic as we were in the US, because that's the way the global interest rate structure was. That's reversing, and we would neutralize that bet.
I would say I think the big fear about China is the kind of leverage that it's taken on in the last few years, and it's really been centered in state-owned enterprises. But if there's any country that can control soft landings and manage things like this, it's China. I think there is a real call to enact structural reforms, and I think there is some willingness to do that. I think now that Xi has consolidated power, looks like he's going to be at the helm for a lot longer, I think he's going to be more likely to address issues like this. We've heard from the head of the PBOC, who's been very vocal about suggesting that we've got a lot of debt, that there's the need for structural reforms, and I think we're going to start to see those. So China, over the shorter term, we may see a few hiccups, but I think over the longer term, it will do the things it needs to be equipped to prosper.
So maybe that helps to answer some of the worries that analysts have about the iPhone 10 in China. But Jeff, let's also talk about Alphabet. They also report after the close. It's another holding of Action Alerts Plus.
Yeah, and first off, I want to start to say I'm not making any calls on the quarter
Sure.
when they report today. But I think when you have with Alphabet with their longer term story, I mean, they have an excellent search revenue business for advertising. And what they're able to use that powerhouse of a platform for is to fund all of these other bets and other projects. Like specifically one that we're very high on is Waymo, which is an autonomous driving company. These are funding these larger bets. At some point, Alphabet, they're going to see that they have these real winners in these companies, and they could potentially spin them off, and they haven't even started monetizing them yet. So again, we think Alphabet, an excellent story, cloud platform too as well.
Obviously, Amazon Web Services, Amazon reports they're going up against Alphabet and Microsoft when it comes to the cloud.
Yeah, but there's plenty of market share for all of them. I mean, it's a huge business world, and there's ton out there. And then Amazon, you have that specific story too. I mean, they're retail, they're cloud, and now they're getting advertising as well. And now you have news, maybe even healthcare. So I mean, they're just. I would want to. Amazon, great. I would not want to hold anything that's in their warpath.
And Lizanne, it's interesting because tech is not the best performing sector so far this year. It's actually consumer discretionary stocks. What do you make of that dynamic?
Well, I think Amazon has a bit to do with that, but also I think retail broadly was sort of left for dead, and it became a bit of a value story. And I think you're finding more of those value stories the way I think about value and growth. So we actually don't make recommendations, traditional recommendations, overweight value or overweight growth, because I think there's the fundamentals of value and growth, and then there's the index labels of value and growth. And there are times where you can find value inside stocks and sectors that are almost permanently housed in the growth indexes. And then there's times where stocks that are almost permanently housed in the value indexes run up and don't offer value. So I think that retail, even though it became, it's always considered a growth sector, became an area where investors went for value. In an environment where growth is more ample broadly in the economy, that's when you want to have a bit more of a value orientation in how you look at companies and industries.
So how would you categorize the industrial sector given all the themes you just talked about?
So we have industrials as a market perform, so kind of a neutral rating on industrials. Our three outperform sectors, two of them cross over with Tony's, are technology, financials, and healthcare.
But Jeff, when it comes to industrials, look at Boeing. That stock's on fire.
Yeah, I mean, they've been on fire, and they reported yesterday, and when you have a stock that's been as hot as Boeing, you need to have a perfect quarter to maintain that status, and that's what they did. Their cash flows were off the charts. Their orders, their demands for their planes, it's such a secular growth trend right now in that defense aerospace area. And then you even had UPS today came out and said, we're ordering more Boeing planes. So that doesn't seem like that's going to slow down at any point.
Plenty of read-through to Honeywell, which is another holding.
Yeah, absolutely. And we like Honeywell not only for their upcoming catalyst opportunity in a future spinoff, but they have a nice, decent size aerospace exposure as well. And that's one area we think they're going to be active in the M&A market this year. We could see them beefing that business up.
Tony, weigh in on the industrial space here.
We're overweighted because they benefit from the tax cuts. They benefit from the capital spending kind of acceleration that we're seeing here. But to Jeff's point, I think what we do, and we advise clients to do, and I advise the viewers to do, is go and look at a stock that you think is up too much, put it against its 50-day moving average, and create a histogram. Stocks are very consistent. Like Boeing, when it gets up to this kind of level, typically doesn't get this much more extended at all relative to the 50-day. So typically we're very fundamental, but you have to throw some of that kind of, because it's a measure of human nature and sentiment. How high should these stocks go? Boeing is another example of that. Boeing is so extended above its 50-day, whenever it gets up to this kind of level, generally, you don't want to chase it. It doesn't mean you want to sell it. And I think that's the message we got to be careful here of. We're still in a fundamentally driven bull market, also driven by credit. The last thing you ever want to do is get negative until well after an inversion of the curve. But you just wait for some of the names that Jeff's in the Action Alert portfolio and maybe take advantage of weakness that happens. Be that active manager that we advise.
Kristina, you said earlier you were excited about tech, but when you see some of the numbers in the industrial sector, how does that change your view?
Well, certainly industrials has opportunity, but it's more about an earnings growth story as opposed to a revenue growth story. The revenue growth is actually pretty anemic in the industrial space based on current estimates. Tech actually has significant double-digit revenue growth projected for 2018. So I would err on the side of revenue growth over earnings growth, all else being equal. And so I'm more excited about technology. I also think if you look at valuations relative to history, they're not that expensive. So that makes a good destination. Of course, financials also look good.
Jeff?
Yeah, I completely agree. And I do think that you need to look at the top line, the bottom line as well. Yeah, absolutely.
Tony, go in.
So the top line hasn't been great, but it has been accelerating. Like Q4 of 17, this current quarter that is being reported, you had 8.4% top line growth out of the industrial space. So that's probably going to accelerate. And I think that's really the great message of 2018 relative to prior years in this cycle, is you really are getting that top line growth. You're finally getting the upside. You've got, I think it's 80%, according to Thomson Reuters, of those companies that report revenue versus expectations are beating.
Yeah, the beat rate.
Like that's been like 50%-ish most of the cycle.
Let's also talk about M&A activity, because this year so far in January has been a pretty banner year. $308 billion worth of deals have been announced since the start of the year. That's the highest since 2000, according to Dealogic. Do you guys think this is tax reform related?
I think it's credit market related and the need for credit. If we have I call him our bond dude, Brian Reynolds, who joined us recently. He scans pension investors daily and Bloomberg and every other source you can find to see where pensions are putting their money. And contrary to what people would think, it's stunning, actually. They're putting it all in credit. But in credit, they're going into M&A funds. They're going into levered credit funds. They're going into private equity funds, which drive some of the M&A. So the money flow into the space that needs to be put to work is extraordinary.
Foundations and endowments, too.
That's right.
In fact, the pendulum had actually swung a bit away from all things alternative back toward the public markets, but now you're seeing a shift a bit back to your point in credit and M&A.
Although what is the rise in M&A activity so far this year kind of say about the markets in terms of what we should expect this year?
There's just a boatload of money out there that needs to find a place to go to work. It's just still a massive, not just U.S., but global liquidity story. And it's manifested itself until recently, of course, in the cryptocurrencies. It's manifested itself in the art market. You name it. We're
going to talk about cryptocurrencies in a moment.
Oh.
Your favorite topic.
Why'd you do that?
Sorry.
Why'd you do that?
Oh, I would have done it. Jeff, when it comes to M&A activity, though, I mean, Danaher, that's one stock in your portfolio that is considering M&A activity this year.
Yeah, I mean, it's one of many. I think that they've done such a good job with their, they call it the Danaher business model, where they essentially, they work to increase margins and increase growth with everything that they do. They're one spot. Life sciences is one part that they're attacking. I mentioned Honeywell before, potentially getting into something with aerospace. So I mean, I think that especially with all the cash that they have, people are looking for ways where they can build upon growth, and acquisition M&A is always an easy spot to go to. And
there's also this very complex dynamic going on right now in the semiconductor space, right? Broadcom trying to buy Qualcomm, Qualcomm trying to buy NXP Semiconductors.
Yeah.
Update us on this dynamic.
Yeah, so the first one there is that Qualcomm is trying to buy NXPI, and they're trying to get enough shares tendered from the shareholders to accept that bid. Right now their offer is 110, NXPI trades at 120, so very unlikely that people will tender into that deal. We think that Qualcomm is waiting for regulators in China to approve the deal, and then we think likely they'll raise it. And then again, we hold NXPI, and the other name in that picture is Broadcom, who's trying to acquire Qualcomm for about $70. There's speculation that it might move to $80. There's been a lot of back and forth between the two companies whether or not it will get that necessary regulator approval. It was even reported that Broadcom might even want to go to a hell or high water provision, meaning that they're willing to divest any assets possible just to make sure that deal will get through. Now today it's a breakup fee, one of the biggest breakup fees ever could come into this as well. So a very, very big story here. But my takeaway is that we actually think that each could actually end up being a winner from this. NXPI, I think, their shareholders would obviously get a win if that bid price gets raised. Broadcom, we think that it's a great story in itself that if they got Qualcomm or not, we think that stock price could go higher, and it's the uncertainty around the bid that is sort of what is anchoring shares now. And Qualcomm too, they would get that accretion from the NXPI deal. They have some good things going on in the 5G space, so we think that stock, where actually the $70, perhaps $80 bid could actually be too low of a ceiling right now for them.
Tony, does the rise of the semiconductor space kind of further illustrate your point of active management, that it's not just enough to have tech, you have to dig deeper and go into the semiconductor space?
Well, I totally agree with that, and because I wouldn't be able to differentiate like Jeff just did on these names. I would have no idea. Most people have a day job. You know, you need, when some things aren't going up every day, you actually need somebody to differentiate the news items that come out. But just the semis in general, as I was going through some of the charts, they're one of the space that is extended above its 50-day moving average. It's just, there's been such a rush of money, to Liz Ann's point about liquidity, that it's just gone into anything. And now it's looking around saying, uh-oh, what do I do now that I've done that? And that's where the opportunities are created.
All right, and now I want to go back to Liz Ann's earlier point about cryptocurrencies. You don't?
You know they're going to take that clip and you're done now.
It's going to be everywhere. But seriously, Bitcoin was at 19,300 on December 16th. It's now below 10,000. Lowest point,
9,000.
is it 9,000? But lowest point of 2018 it hit today. Have you been getting calls about Bitcoin from clients?
So we were getting a lot of questions up until this recent rout. Now it's a little bit more crickets. I'd say, at least among our investors, we didn't have a lot of what I've been calling the fanboys. Just the adherents that just could not be talked off their view that this was, the second coming. The concern that I'm sure anybody that is skeptical about this is expressed is it's not backed by anything, no intrinsic value, but it almost had a bit of a sort of greater fool theory pyramid scheme. And one interesting conversation I had with somebody who was used to be a big believer until the price went down, and now he's not so much a big believer anymore, but was that it was. We believe in it because we distrust the system, fiat money. And I said, well, what is it about the Bitcoin system you trust? Well, I trust the community. Well, in that community are also hackers that recently are able to steal $500 million worth of Bitcoin on an exchange, and no one seems to have any idea sort of how, where it is. So I think the bloom has, to some degree, come off that rose. Not so much just because the prices come down, but the hacking theft story, I think, really shocks some people.
And Tony, there have been worries about the exit of Bitcoin, right? If you have Bitcoin, I mean, how do you get your money out of it? Liquidity issues. I
have to say that I know 0.00 about Bitcoin and crypto, only because I'm just not smart enough to figure. I mean, I've tried to have people explain it to me, and I still don't get it. I do get the fact that everybody from the mailroom guy to the traders on the desk are wanting to get involved a month ago, and now there's absolute crickets. And what people are finding out is there are risks in markets that you trade, whether it's Bitcoin or a semi name or some other name that's an industrial name. There's risk in the market, and that has not been seen up until recently. Like, I had one person call me today that got involved in one of the cryptocurrencies that just said, am I going to lose all my money? And I gave the same response that they asked me if they should buy it. I have no idea. And I think that's the problem with some of the cryptocurrencies, is there's still a lot of uncertainty around.
Well, and I think to your point, some of these Bitcoin enthusiasts, shall we call them, don't care about the risks. They're just in line with this, I don't trust the government.
Yes, but I would ask some of them, I would guess that some of them that said they didn't care about the risks, didn't care about the risks at 19,000, but they probably care about the risks at 9,000.
Yeah. Kristina, do you think the hype is fading?
Oh, absolutely. I think ultimately Bitcoin will probably be the currency of choice for libertarians, and that'll be the extent of it. I mean, it's a very interesting idea. The technology behind it is interesting, and there are ways to invest in the stock market. But the reality is that Bitcoin itself is incredibly flawed. And we're seeing more and more of that every day. While the idea is that it's not hackable, most people buy it through an exchange that is absolutely 100% hackable. And this isn't the first theft. We know Mt. Gox in 2014 was the biggest exchange. It was shut down because there was an enormous theft there. Nobody wants the government's involvement until something bad happens, and then everybody wants the government's involvement. And so actually my theory is that Bitcoin's technology will be built upon, and we may actually have a more perfect currency, because this isn't a currency, this is a speculative investment. We may one day have a staid cryptocurrency, but it will probably be called FedCoin because it will be created by the Fed. And they've talked a little bit about doing that, and I think that's ultimately the way this will go, because Bitcoin is not what it was intended for.
FedCoin would be the demise of Bitcoin.
My friend Tim Seymour at CNBC had a great comment one time, and it was, I'd love to take credit for it, it was, we shouldn't be worried about if it goes bad. We should worry if it works. And you change the dynamic of the need for a primary default currency such as the dollar, the euro, or the yen. Because then you have a lot more chaos globally than you have with the major economies in charge of the money.
But what does that mean? What does that mean if it works?
In other words, if it dislocates the U.S. Dollar from being a primary currency.
And there are no adults to control things. That's why South Korea has closed down its currency exchange. China has done the same thing, because they recognize that this could be a problem that could infect other areas of the economy.
Now there are things with the blockchain and crypto that I'm sure make sense, and a lot of firms, ours included, are looking at those. And I just want to make it clear that I'm commenting that I don't know, because there's just not enough information that I can understand about them, and it's forthcoming. Nobody understood the internet when Netscape came public in 1995. And that was the beginning of the internet. So it's one of those things that, you know, more research and development will figure it out.
Kristina, you brought up how there are stocks to play the Bitcoin crypto craze, and Jeff, NVIDIA is one of them, albeit a small part of NVIDIA's overall business.
Yeah, I would say it's a play on it, but it's not its story. So, I mean, we've seen reports that Bitcoin and Ethereum, the mining for that, to do that, you need NVIDIA's GPUs, which are the best in the market, and also one of the cheapest. But it is a smaller part. I do think some of this run in NVIDIA is related to that, which isn't great, and when the stock is trading at almost like it's about a 50 multiple right now. It is kind of concerning, which is why we actually took some back in this, you know, very, I'll say greedy market per se. But again, it's not the story. NVIDIA's story is gaming. It goes back to data center, which I brought up earlier is very underappreciated in the market, and machine learning, autonomous driving.
We have about 2 minutes left. Let's go around the table and just give people either one thing to watch in the coming months, one tail risk for the market that you're watching, a final piece of advice. Jeff, we'll start with you.
I mean, one thing to watch, I'll say that's continue to see what the Fed does and see what their comments are, and then see if inflation can pick up. Tail risk, I'll go geopolitical. I think that there's always uncertainties, no matter no matter what it may seem like in the world, between North Korea and the peninsula out there. So I think that's one thing that you should always be mindful of.
Lizanne?
Yeah, I think inflation, I think it's what to watch, and I think it also represents the risk. I think any corrective phase, whether you consider what's happened in the last week, one of those, I think will likely have an inflation marker on it in some form.
Is that a 2018 risk, or more so a 2019 risk?
2018 risk. I think we are finally going to start to see traditional relationships kick in, like the Phillips curve and wage growth, which is great for workers. I actually think as a result, we may have an environment this year where Main Street feels a bit better than Wall Street.
How about that? Tony?
Our main input would be corrections are only natural, normal, and healthy, are considered that way until you actually get them. But again, we would use any significant weakness as an opportunity to buy the sectors that we've talked about because credit is still available. The risk being, I agree with Lizanne, it's going to be inflation expectations are going to make people worried about the Fed, so the monetary policy uncertainty increases. That creates volatility, but still, until you invert the curve, that creates opportunity.
Kristina, we'll give you the last word.
I would agree. We want to watch central banks, not just in the U.S., but outside the U.S., for signs that they might tighten more than expected. But we also want to look at protectionism. Right? This has been a very global economy in recent years with trade barriers coming down. We could be seeing the start of protectionism growing, which has historically provided headwinds to the economy. Now, that's probably a longer-term risk, but we want to watch it. And I guess my final word would be that in the last few years, investors have lost sight of the importance of diversification because it has been so easy to just be in stocks and do well, and frankly, to just be in an index fund and do well. I would argue that 2018 will be the year of diversification, the year of active management, where the importance of having allocations to non-correlating asset classes, to differentiating within stocks will matter.
All right, we'll leave it there for right now. Guys, thanks very much for joining us.
Thank you.
Thank
you
you
for having us.